So one of the most covered stocks this year by analysts and journalists and things like that is one that you might not expect. It's a medical office REIT called Medical Properties Trust. Tyler, if you had told me at the beginning of this year that Medical Properties Trust was going to dominate the headlines, I would have said you're crazy. But it was a very high dividend stock, which is the real reason that it got so much in attention from investors. It had a double-digit dividend until recently. And recently, the news for investors hasn't been great, especially if you bought it for income. It recently did a 48% dividend cut, essentially cutting the dividend in half to make sure the business is sustainable. It sold a bunch of assets that reduced the amount of rental income it's getting. So is this stock still a buy now? Should investors be disappointed, or should this be an encouraging sign that maybe it's a sustainable business?
Well, it didn't just happen to have a double-digit yield by accident. The company actually was the subject of several short reports earlier in the year, kind of highlighting some of the reasons that it became so newsworthy. One of its primary clients or tenants was in financial distress. And so there was a lot of concern that that company wasn't going to be able to pay its leases on a lot of its stuff. There's also concerns that they may have been overpaying in for a lot of this new growth, and so returns were not great. And kind of all those things just eventually start to tumble together into they all come to a head to eventually. So that's where we kind of landed here. Now, there's is it the buy now? I'm going to do my best to make the case for before I turn negative. But if I squint hard enough, there's a possibility there's some value here. Look at the current price. Its trailing price to book value is 0.5. So the market is basically saying, like, even after sales and massive write-downs, we think that this is not great. So the argument could be made is even after all of those things happen, it could still be trading at a discount, because that's a significant discount to your book value for a business. And even with all of the not great stuff as of late, it was only trading for like a little more than 6 times free cash flow, or using like GAAP numbers versus adjusted FFO or anything like that. So you could make the case, and if you squint real hard, you'd be like, well, it is really cheap. Maybe the market's overreacted a bit. But there's also part of me that says, like, when you find one cockroach in the cupboard, you tend to find more. And so there's part of me that says they may not be done with asset sales. They may not be done with some of the other things that they've had to do to right the ship. And until maybe we get like a couple quarters of them being like, look, we think we're good now, then maybe. But there's just that thing in the back of my head that says, something else, the other shoe could drop here. Let's see what happens.
Yeah, and I mean, it's also worth noting that book value is a tough metric to really use in cases like this, because it's generally based on the price that they paid for the property. So if the value of their assets has declined, which it looks like it has, the book value doesn't tell the true story. So I mean that to kind of clarify, you're not saying it's trading for half of its actual intrinsic value.
No.
It's trading for half of the carrying assets on its balance sheet.
Exactly. So what I'm saying is, like, even if like its assets are valued for way less than what they are on the books, there may be a possibility where there's even still value at that. But again, I don't even know if I believe that. That's just me trying to make the bullish case for it. And I don't even know if I believe it.
Yeah, it could be a deep value play. It could go the wrong way. For me, I put this in the too hard basket. There's just too much going on. It could be a great income play, but in the current environment, I think it's relatively easy to get a 6 or 7% yield that I like a lot better, and like the company's prospects a lot better. So if you're just an income investor and not just kind of trying to, get a cigar butt company, as Buffett would call this, a business that might have a couple good puffs left in it. But if you're an income investor, I think there's better places to look. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.